Hello everyone, today we will explore Adidas' strategic journey from 2022 to 2025. This period represents a critical era of transformation for the global sportswear giant, as the brand moved from a challenging phase of restructuring to a powerful resurgence. We will now take a closer look at how the company's performance evolved year by year throughout this turnaround era. So now we begin with the financial analysis of our representation. 2022 was a critical year for Adidas as revenue hit $22.5 billion, but growth remained stagnant due to massive disruption. The company faced three major blows: exiting the Russian market, ending the profitable Yeezy partnership, and facing severe obstacles in China. This difficult period served as the ultimate stress test, leading to a leadership shakeup with Paul Gulden taking over as CEO to spearhead the recovery. So, the decline in China was a double whammy caused by zero-COVID lockdowns and shifting consumer loyalty. Beyond closed stores, Adidas faced a backlash over Xinjiang cotton and the rise of the Gucci chain, where national pride pushed sharper toward local brands. Rivals like Li-Ning and Anta moved faster to meet cultural demands, forcing Adidas to rethink its strategy to regain its footing in the region. So, Russia's invasion of Ukraine forced Adidas to start on business in the country, leading to almost €350 million in losses from closing stores and dumping stock. This sudden exit destroyed a reliable source of income for the EMEA region. By also cutting ties with the Russian Football Union, Adidas not lost any hope of recovering in that market anytime soon. Next, in late 2022, Adidas faced a massive commercial hit by ending its partnership with Kanye West. This split caused revenue to drop by €600 million in just the last 3 months of the year. North America was hurt the most, leaving Adidas with billions in unsold shoes. The new leadership team now faced the huge task of managing this leftover stock and filling the hole in the company's profit. Building on the richest year of 2022, 2023 served as a critical period of stabilization where reported sales reached €21.4 billion, a 5% dip from the year before. Despite this slight decline, our underlying performance remained flat when excluding currency swings, showing that we were successfully protecting our core business. However, we still had to navigate significant macro headwinds, including a €1.2 billion revenue gap from Yeezy and another 5% loss caused by weakening currencies in emerging markets. Next, to move past these financial hurdles, we shifted our strategy to prioritize brand prestige over quick sales by deliberately cutting shipment to wholesalers and outlets in early 2023. We clear retail shelves and avoid the trap of heavy discounting. Although this short-term thing impacted our immediate revenue, zeroing in on high-demand hits like December and Gazelle successfully stabilized the ship and set up for the powerful rebound we see today. Following the stabilization of 2023, 2024 marked a powerful shift from playing defense to full-on attack mode under CEO Paul Gulden. Full-year revenue jumped to €23.683 billion, representing an 11% increase as our growth strategy began to pay off globally. Footwear led this chart with a 17% increase, fueled by the massive terrace trend and brand hits surrounding December, Gazelle, and special models. This momentum was further amplified by Euro 2024, which boosted replica sales and lifestyle iteration to new peaks. Most impressively, strong sales and better cost management pushed our operating profit to nearly €1.3 billion, a staggering fivefold increase compared to the previous year, proving that Adidas has officially returned to a path of high-margin growth. So, building on 3 years of intense restructuring, 2025 became the year Adidas fully broke free from Yeezy reliance and established a rock-solid financial foundation. We hit an on-time record revenue of 24.811 billion euro, reflecting a strong 10% currency-neutral growth. While a stronger euro impacted our reported figures by over 1 billion euro, our ability to hit these record numbers while stabilizing global inventory proves that the turnaround is complete and the brand is stronger than ever. This record-breaking success was balanced across all divisions, proving that our brand hit is both sustainable and diverse. In our performance category, growth reached 50%, led by a staggering 30% surge in Adizero running shoes. Meanwhile, lifestyle rose 12%, confirming the lasting power of our originals. Geographically, we saw a total recovery as North America grew by 10% after facing past inventory issues, and China climbed 13% through smart local strategies. This broad-based momentum drove our operating profit to 2.056 billion euro, up to over 50% from the previous year, wrapping up an incredible comeback story. So, following our record revenue, our gross margin saw a significant leap from 47.5% in 2023 to over 50% in 2024, eventually reaching 51.6% in 2025. This impressive proves that Adidas has regained its pricing power by reducing shipping costs and dialing back deep discounts. So to achieve this, we make a strategic trade-off by pulling back from heavy discount wholesale channels like TG Maxx and Marshalls, allowing us to clean up distribution and lean into high-margin classes like the Samba and the Gazelle. This improved margin directly fueled our operating profit, which rocketed from a dismal 268 million euro in 2023 to 1.34 billion euro in 2024, with a projection to hit 1.8 billion euro by 2025. This turnaround has delivered a much leaner and more agile operation, where every euro of revenue now generated significantly more surplus. While we had to cut back on some risky new pets to focus on streamlining costs for our core products, the result is a far more efficient business model. So finally, the most significant within this journey is our net income recovery. After recording a shocking net loss in 2023, the first in over 30 years, Adidas turned things around by posting a 764 million euro profit in 2024 and pushing toward 1.5 billion euro in 2025. This spectacular comeback has fully restored investor confidence and freed up abundant cash flow to plow back into the business, ensuring a sustainable and profitable future for the brand.
So to kick off our analysis of operational efficiency, we will focus on two critical areas. The first one is inventory management and the second is operating working capital. Regarding inventory management, the 2022-2025 period saw a complete overhaul of Adidas logistics system. 2022 was actually the peak of the crisis, with inventory levels surging by 49% to hit 6 billion euro. This was caused by two major shocks: a sudden downturn in the Chinese market and the termination of the Yeezy partnership, which left about 500 million euro worth of stock frozen in warehouses. And moving into 2023, Adidas took a aggressive action to clear the system, reduce inventory by 24% through limited release Yeezy drops, and a strategic tightening of wholesale channels to help retailers clear out old stock. And finally, by the 2024 to 2025 period, inventory levels returned to an optimal threshold of around 4 billion euro, successfully reestablishing a healthy balance between supply and demand. Regarding operating working capital, under the leadership of CEO Bjorn Gulden, Adidas operating working capital as a percentage of revenue dropped sharply from 25.7% in 2023 to 19.7% in 2024. This achievement was driven by three core strategies. First is inventory liquidation by gradually selling off remaining ZZ stock. Secondly is accelerated debt collection by shifting focus toward direct-to-consumer channels to improve cash flow. And thirdly is supply control. For hot franchise from Samba or Gazelle, supply was tightly restricted to maintain full price sales and prevent future inventory buildup. By shortening the operating working capital cycle, Adidas unlocked massive cash reserves to settle debt early, fueling a spectacular turnaround during this period. Let's look at the company's financial health through its debt metrics and credit worthiness. There are three content in this part: debt to equity ratio, interest coverage, and credit rating. First, debt to equity ratio. We are seeing an extremely positive signal here, as the debt to equity ratio decreased from 1.29 in 2022, approximately 0.96 in 2025. To put that in perspective, in 2022, for every €1 of equity, Adidas carried out €1.29 in debt, bringing this ratio below 1 by 2025, demonstrate a very successfully balance sheet restructuring. This decline stemmed from proactive repayment of maturing long-term debt and an increase in retained earnings, which bolstered equity after the ZZ fallout. Ultimately, reduced debt ratio gives Adidas much more autonomy in its strategic investment decisions. Next, interest coverage. While 2023 was a difficult year due to the operating profit contraction following the ZZ discontinuation, we have seen a strong rebound since 2024. More importantly, the actual cash outflow for interest remained low relative to the cash generated from operations. This proves that Adidas can rely on its financial obligations, which substantially reduce its default risk. Finally, credit rating. The ultimate proof of this financial strength is that S&P Global recently upgraded Adidas credit rating to A. This upgrade was driven by a stronger than expected performance in core products and a fast-paced deleveraging than analysts predicted. And with an A rating, Adidas is officially classified as a financially strong enterprise, with its current debt risk evaluated as low by the international financial community.
Good morning, everyone. Today we are going to conduct a structured competitive analysis of Adidas AG using Sports by Sport framework, one of the most powerful tools in strategic management. It is not just a theoretical exercise. We'll be examining the real force shaping Adidas market position right now, from the face of actual new challenges like on-running to the geopolitical pressure on the supply chains. And by the end of this presentation, you will have a clear picture of where Adidas stands competitively, what keeps them strong, and where the real risks lie heading into 2025 and beyond. The first and most dominant force we need to examine here is competitive rivalries. And for Adidas, this is where the battle is fought. The intensity here is rated very high, and for good reasons. Adidas operates in a market saturated with powerful incumbents. Nike dominates with massive R&D investment and brand equities. Puma competes aggressively in the mid-market. Under Armour continue pursuing into performance segments. This isn't a market with one or two competitors, it's a constant and multi-front war. To maintain what Adidas internally called brand health, the company has increased its marketing spend by 12% year-over-year, reaching 2.84 billion euros. That numbers tell you everything about how intense this rivalry is. You simply cannot afford to go quiet. Strategically, Adidas has made a smarter counter-move by reactivating its heritage lines, specifically the sandals and gazelles. These aren't just nostalgic plays, they are calculated repositioning efforts to capture the lifestyle and streetwear segments, where margins are healthier and brand loyalty is stronger. And the key takeaway here is competitive rivalry is not just intense, it's increasing, and Adidas is expanding and innovating to hold its ground. Now let's break this rivalry down into two structural dimensions. The first is the top-down pressure from Nike. Nike's scale advantage is extraordinary. Their R&D budgets, global distribution, and market capitalization create a sustained pressure on Adidas across every geography and product categories. This isn't a free competition, it's a war of attrition on innovation cycles and brand investments. And the second, arguably more strategically dangerous, is the bottom-up pressure from actual challengers. Some brands like On Running and Hawkers are trying to compete everywhere. They are certainly attacking technical performance segments. On Running alone has gained approximately 3 market share in a relatively short window. These brands move fast, require less overhead, and resonate deeply with performance-oriented consumers. This brings us to the concept of structural risk. If Adidas market share decline exceeds 0.5% on a sustained basis, that would no longer be a cyclical dip driven by fashion trends. It would signal structural erosion of their competitive positions. This is a fundamentally different problem and a much harder one to reverse. The message here is clear. Adidas must fight on 2 fronts simultaneously, defending against Nike at the top and block actual insertion from below. Moving to the supplier bargaining power force, the intensity here is rated low to moderate, but with some important nuances that could shift that rating upward. On the positive side, Adidas has built a highly fragmented supplier base across more than 60 countries. No single factory accounts more than approximately 5% of their total production. This is a deliberate strategic choice. It prevents any one supplier from holding significant leverage over Adidas operations. However, there are 2 pressure points worth watching carefully. First, geopolitical risk. Approximately 35% of production is still concentrated in China, and in the current global trade environment with tariff volatility and geopolitical tension, this concentration creates real exposure, and a sudden disruption in that supply corridor could have significant operational and cost implications. Second, the compliant fibers. Adidas has committed to sourcing 90% of sustainable materials by 2025, and this is admirable from a brand and ESG perspective, but it has an unintended consequence. It narrows the pool of qualified suppliers who can meet those standards. Fewer eligible suppliers mean increased leverage for those who do qualify. This is a risk that will pose a sustainability targets approach. So while the supplier power is manageable today, the trajectory is slightly upward, and Adidas must actively manage what its geographic diversification and its sustainability sourcing strategy. Moving on, threat of new entrants, rated low to moderate. Adidas' global supply chain across 60 countries and the audit quality ecosystem create general barriers. Replicating this takes years and billions of dollars. but the threat is more real than it appears. E-commerce and social media have democratized brand building. On running crossed $2 billion in revenue in under a decade, a pace that was nearly impossible in the pre-digital era. The structural barrier is real, but the speed at which niche brands can scale has compressed significantly. Adidas cannot afford complacency here. Buyer power is rated moderate, sitting between two opposing poles. Billions of fragmented global consumers mean no single buyer can exert meaningful pricing pressure, but digital channels have created extreme price transparencies. Consumers can compare brands across dozens of platforms in seconds, squeezing wholesale margins. Adidas' answer is the DTC purse, targeting 50% of revenue from direct channels. The payoff is transformational, a potential 300 to 500 basis point gross margin improvement. Buyer power is trending slightly decreasing this pivot tackles a positive signal for long-term margins. Next, breadth of substitutes rated moderate to high, and this for is cumulative and multi-directional, not just from other sneaker brands. In fast fashion, Zara's and H&M's are capturing athleisure volume in casual segments. Luxury brands like Loro Pianos are redefining premium sport elegance for high-income consumers. Counterfeits, especially in Asia, eroding brand equities and diluting the premium perception Adidas has worked hard to build. The trend is stable, but this requires constant monitoring as fast fashion deepens its footwear purse. Now, let me bring on 5 sports together. The first one is competitive rivalry, very high, increasing the most urgent priorities. Next, new entrants, low more stable, real barriers, but digital brands scale faster than ever. Next, supplier power, low more, slightly increasing. China concentration and sustainability shortage are the watch item. The fourth is buyer powers, moderate, slightly decreasing. DTC is working in Adidas' favor. And finally is substitutes, more than high, stable, a persistent multi-front challenge. And the most acute pressure is rivalry. The most encouraging trend here is buyer power declining as DTC expand. The lever Adidas control, DTC, supplier diversification, heritage brand strategies are the right ones to pull. To close, Adidas is executing well in key areas. DTC is expanding margin. Stamper and Gazelle have been a trend brand win, and revenue is up to 11%. But three risks remains. The first one is over-reliance on trend cycles. Fashion is inherently volatile, and no heritage revival lasts forever. Second, China's supply chain exposures, a structural vulnerability in today's geopolitical environments. And finally, technical challenges like on-running and hawkers are well-funded and accelerating. The strategy is sound, but the execution window is narrow and the competition won't slow down. The companies that win here combine operational discipline with general brand innovation, and that's exactly the balance Adidas must maintain.
Looking at the broader market sentiment, Adidas is currently receiving very positive analyst coverage. Around 81% of analysts recommend a buy rating, while the remaining 19% suggest hold, with almost no sell recommendation. In addition, the average analyst price target is around €207, implying nearly 47% upside potential compared to the recent stock price. The main argument for buying Adidas comes from its strong financial recovery and growth momentum. In Q1 2023, Adidas reported a 14% currency-neutral revenue growth and an operating profit of €705 million, exceeding market expectations by around €60 million. These results suggest that the company is regaining momentum after previous disruption. Despite the strong recovery, some analysts still recommend a hold strategy due to external economic risk. Adidas expects around €400 million of pressure from tariff and currency fluctuation in 2026. In addition, gross margins declined from 52.1% to 51.1%, which may create short-term volatility and uncertainty for investors. So at the moment, the argument for selling Adidas remains relatively weak. As of the end of 2025, there were virtually no major sales recommendations from analysts. This reflects strong confidence in the company's management, recovery strategy, and long-term brand value despite current market challenges. So in conclusion, Adidas has shown strong recovery in both financial performance and investor sentiment. Analysts project approximately 30% to 40% upside potential in the long term. However, due to ongoing market uncertainty, a cautious hold strategy or gradual accumulation during price collection may be more appropriate than aggressive buying.
I will continue the presentations about the non-financial analysis of Adidas, focusing on ESG and CSR and how these factors affect financial performance. And my presentations had three parts: ESG strategy, ESG factors, and the link to financial performance. According to European Sustainability Reporting Standards, Adidas built its ESG strategy based on three pillars. First, environment, reducing emissions and climate impact. Second, the social, ensuring safe working conditions. And finally, governance, transparency and risk management. So to understand ESG at Adidas, we must look at its business model. So Adidas generates GHG emissions in three following ways: Scope 1, 2, and 3. For the Scope 1, includes direct emissions from sources like offices, facilities, and companies' vehicles. Scope 2 refers to indirect emissions from the energy Adidas buys, such as electricity and heating. And finally, Scope 3 emissions are different. They happen outside the company's direct control, and most of them come from the supply chains, including raw materials, manufacturing, and the product's life cycle. So Adidas does not produce most of their products itself, but outsources to suppliers. As a result, more than 98% of emissions come from Scope 3, and this means ESG risks mainly come from suppliers, not internal operations. So this directly affects production costs, supply chain stability, brand reputations, and long-term revenue. So ESG is not just a sustainability issue, but also a financial issue. So look at this table, focus on blue box. Scope 1 and 2 decreased by about 22%, while Scope 3 only decreased around 5%. This shows Adidas control internal operation well, but still struggle with supplier emissions. To improve this, Adidas focused on both internal operations and supplier. Internally, it increased renewable energy, improved energy efficiency, and optimized data tracking, also helping reduce emissions and cost. In the supply chain, Adidas used recycled materials, increased renewable energy used by suppliers, and improved logistics and packaging. So through the charts, you can see that Adidas increased recycled polyester usage from 50% in 2019 to 99% in 2023. So while the global average remained around 12 to 15%, this highlights Adidas' strong shift towards sustainable materials and lower environmental impact. So as a result, Scope 1 and 2 emissions dropped from about 164,000 tons to 128,000 tons of CO2, a 22% reduction. However, Scope 3 emissions only decreased by around 5%, which is still far from 42% reductions target by 2030. And in the long term, Adidas aims to reduce Scope 1 and 2 emissions by 70% by 2030 and Scope 3 by 42% by 2030 and achieve net zero emissions by 2050. From a financial perspective, these actions reduce costs and improve efficiency, but slow Scope 3 progress remains a key risk. So ESG actions impact financial in four ways. First, they increase revenue through stronger brand image and customer loyalty. Second, reduce costs in the long term through energy saving. Third, is great risks such as carbon pricing and supply chain disruptions. And finally, attract investors, lowering the cost of capitals. And overall, environmental actions not only fulfill responsibility but also drive revenue, optimize costs, and reduce financial risk. Now let's move to the next factor, the social factors. Because Adidas depends on suppliers, so it faces risks like poor working conditions and labor violations. So Adidas manage these risks by several actions. First, the company conducts regular audits. Second, they apply a strict code of conduct. And they also support suppliers to improve working conditions. At the same time, Adidas focus on fair wages, diversity and inclusions, and employees' well-being to ensure a more responsible and sustainable workforce. So the social factors have the financial impact. So financially, social issues can reduce revenues if scandals occur, while monitoring increase cost but ensure stable supply. A responsible supply chain also improve ESG rating and firm value. However, suppliers' control remains a key challenge. So now let's move into the final factors, the governance. So Adidas focus on compliance, anti-corruption, risk management, and transparency. So financial impact is that good governance reduce information risks, increase investor trust, stabilize stock price, and improve access to capitals. And overall, it strengthens financial performance. For the overall evaluations, first, the strength. Adidas has strong ESG strategy, clear targets, and achieve a 22% emissions reductions. And this supports profitability, lower cost of capital, and drives long-term growth. So, however, there's also the weaknesses. It still depends heavily on the suppliers. Scope 3 progress is low and ESG investment increase short-term cost. Now I will go to the final conclusions. ESG at Adidas is not only about responsibility but a key driver of financial performance. It helps increase revenue, reduce costs, and attract investors. However, the biggest challenge remains supply chain control, especially Scope 3. So Adidas is a strong long-term investment, but ESG risks still need careful management.
Next, I'm going to talk about the technical analysis of the Adidas stock. First, the stock we analyze is the Adidas with the ticker ADS, which is listed on the XETR. XETR is an electronic trading system operated by the Frankfurt Stock Exchange, and it's one of the most largest and the most liquid market in Europe. In this section, we conduct technical analysis on the weekly time frame. The reason we choose this weekly data is to focus on the long-term trends and reduce the short-term noise from the daily fluctuations. So talking about the methodology overview, I would like to present my indicators. So in my technical analysis, we use four main tools, including the EMA, the down theories, trading volumes, and the RSI. Each indicators represent a different aspect of the market. EMA helps us to identify the trend direction. Down theories focusing on the market structure. Volume reflects the market participation, and while the RSI measure the momentum of the market. Instead of relying on the single indicators, we combine them to improve the reliability of our analysis and reduce the subjective bias. So, talking about the EMA, first, we use the expositional moving average, or we call it the EMA. EMA is a trend following the indicators that give more weight and to the recent price, which allow it to react faster to the market change rather than the MA moving average compared to the single moving average. In our analysis, we mainly focusing on the EMA 25 and the EMA 100. While the price stayed below the EMA, it suggests a downtrend. In addition, EMA 25 can act as the dynamic resistance level during the downtrend. A key signal to watch is to the crossover between the two EMA lines, which is the 25 and 100. However, in this case, we do not observe any clear crossover, which indicates a strong trend reversal has not yet occurred. Moving on to the next theories, it is the down theories. Next, we apply the down theories to understand the overall market structure. According to the down theories, market trends tend to continue until a clear reversal signal appears. So it's also emphasized the importance of the price pattern, such as a higher high or the higher low in an uptrend, or the lower high and the lower low in a downtrend. By using these theories, we can identify whether the market is going up or going down or moving in the sideways. Yes, another important indicators we use is the relative strength index, or we call it the RSI. RSI is the momentum indicators that measure the speed and the strength of the price movement. It is commonly used to identify the overbought or the oversold condition. Typically, when RSI is above the 70 benchmark, the market is considered to be overbought. But when it is below the 30 benchmark, it is considered to be oversold. However, the RSI should not be used alone. A more reliable signal appears when the RSI combining with other indicators such as the trend line or the volume. For example, even if the RSI show a bullish signal, we still need a confirmation from the price action and the market structure before making any investment decision. Finally, talking about the trading volume helps us to understand the market participation. An increase in volume indicates a stronger interest from the market participant and can confirm the trend of the trend. For example, strong selling volume often confirms a downward trend movement, while a strong buying volume may signal a potential reversal. Back into our presentation. So after have say about some theories about our methodology, about the RSI, the trade volume, the down theories, also the EMA, we have strong enough confirmation for our advice to whether we're going to buy the Adidas stock or we're going to hold and wait until we have another opportunity to take our money into the market. So let's see right here in this market. So in this market, we have the RSI chart, we have the trading volumes, we have the EMA, and also the down theories. We're going to give you guys about the Adidas stock. So let's consider first about the EMA. So just to justify whether it is the downtrend session or it is the uptrend session. Okay, so from 2022 right here, like the end of 2021, we can see it hits the highest point of all time, and right here the highest point of all time at around 329 euros. And then when it dropped to the lowest point in the last 4 years,
is around $98. $98 is a significant numbers when it dropped from the 329 to $98 euros. So but in 2022 it has a significant recovery into the 255 euros until it's continued the downtrend session until now in 2026. What we consider right here for the Adidas stock is the EMA first. Okay, so we have the two EMA line that we need to focus about. First is about the EMA 25, which stand by the red line, and then the EMA 100, which stand by the purple line. So as we can see, when it hits the highest point of all time and then it had a significant drop, the EMA 25 has gone below the EMA 100. The EMA 25 then recovered and then crossed over against the EMA 100, and then it hits the highest point right here, the high point right here, until they continue the downtrend session, and then the EMA 25 has gone below the EMA 100. So as we can see, when there's a crossover between the two lines of the EMA, which means that they are the change of the price structure or the structure of the chart. So that is first, and we can see, oh yes, another noticeable things that we need to talk about is the price. We can see that the price right here, I'm going to zoom in for you guys to have a better view. Okay, so we can see the price right here. The prices really respect the EMA 25, which means that there are still not any bullish signal for us to buy in the stock right now. So there are no investor may buy the stock right now. Okay, so next we're going to talk about the down theories. What we have in the down theories is just draw the chart. Okay, so this is the low, and then we have the high. We have a higher low, and then the higher high, a higher low, then higher high, until it hits this point, and then they will go sideways. No breakthrough, no nothing, just going sideways, accumulated in a specific period, and then when it drop down here, and then it's create a lower low, a lower high, a lower low, and then a lower high, and then a lower low. This is the down theory. It's about the break of structure, the change of the price structure in the market. So this is the sideways where it's this accumulation, and then this is where it's distributed, the price distribution session. Okay, so that is the price. The down theories. So looking at the price chart right here, luckily we have something that is really similar to the down theories. Because why? Because we have what we have right here is the low, the high, the higher low, the higher high, the higher low, the higher high, higher low, and it's continued this type of structure until it hits this point. It's going sideways in a range, right? We can see it's going in a range, but it has a little bit of fake signal right here because it might go up. But no, we can see that this is the resistance. This is the resistance line. One small resistance. We can cross this with this. This is one small resistance. And when it hit this point, but it cannot break through, which means that we are still currently in the downtrend session. So I will draw the path again. And then it hits the lower low, the lower high, the lower low, the lower high, the lower low, lower high, lower low, lower high, lower low. Combining with it is the respective of the EMA 25, so which means that we are still currently in the downtrend session. Combining the EMA, also the down theories, from those two things that we have, the chart of the Adidas right now is not in the best view, and it's not going up in the next 6 months. I think so. But what we're seeing right here, we have our resistance level right here. So where is our support level? We'll draw for you guys. So our support, the nearest support level is something right here. And as we can see, that Next is about the trading volume. Of course, the trading volume. How can I forget about it? Okay, so this is the trading volume. We have, when it comes to the highest point of all time, we can see that there's a strong sell signal. And until now, we have a lot of like sell signal right here, that which across the moving average of the trading session. We can see like there's the MA cross of the bar, of the volume bar. We can see recently there are a lot of sell volume that move across the moving average of the selling volume. So which means that the price is more likely to be going down in the future, in the recent future. Okay, so consider from the EMA, the down theories, and also the trading volumes, we can see that the price is not really positive for going up, but it's even more likely to going down. Okay, so let's next talk about the RSI. The RSI right here, we have the bull signal in August 25, and then until the end of the 25 we have the bull signal. But the bull signal, which does not mean that the market will go up, it's just the RSI is the relation with the chart, and it's not currently display for the real price of the chart. So what we're going to do with the RSI when it's not related to the chart, we will have this. We will wait until it has another bull signal right here. So as we all know that the RSI right here has to hit the oversold again, and then it comes up and then it's gone down, but it's make what a higher low. It's make a higher low right here, and then we will have the bull signal. All right, we will have the bull signal right here. We call this the bull signal. I will name it bull signal. Okay, this is the bull signal, but in the reality of the chart, we have to wait. Okay, so from this point it's going down, right, and then it hits like this. It's going down even more. It's going down even more from this point to this point. We call this like the bearish structure. Like here, this is the real chart. This is the RSI. So when it comes to this point, we will wait for the RSI to hit the oversold again. Then when it comes back into the safe zone of the range, we will buy in the stock of the Adidas, right? We will buy in when it hits the oversold again. So what we're going to do is wait for until the price go down again. So we can see right here, I will draw this down again, down right here, and then I will go and make it comes up a little bit, and then it's even harder right here. So this point we have the bull signal. This comes up, this comes down. In the reality chart, the RSI comes up, it makes the higher low, and then we will wait, combining it with the buy volume and also the down theory structure. We will consider something to be more like this. Yes, it's break structure. Then it goes down. This is where I consider you guys to buy in the Adidas stock. This is the point where we're going to buy. I will be more likely to advise you guys to buy in this point. And this is our first target, this point right here. And this is our next target, this point right here. This is our two resistance level, and we will buy in the Adidas stock around here when we have the buy signal of the trading volumes. We have the breakup structure due to the down theories, and also it is the cross between the two EMA. What I can see from the EMA right here is this is the EMA 100, right? So when it has something, yeah, it will be like this. Yes. Let's change the color to purple. Yes. And then when the EMA 25 is go like this, it's going to have to break through. Then yes, and we'll change the color to red, right? See, this is when we consider is the uptrend session, and this is a strong enough confirmation for an investor to see whether that they should buy the Adidas stock.
Therefore, instead of making a strong condition of buying, this analysis suggests that investors should wait for a stronger confirmation signal, such as the stronger buying volume or the change in the market structure, or maybe the EMA crossover before considering the large investment position. Overall, the current condition of the market suggests that the Adidas stock may still carry the short-term downside risk, and the cautious approach would be more appropriate at this stage.